Let's transition on to the stock market, equities. The market has been a lot more volatile in the first quarter. So we came out of 2024 with a jump in stocks. The market peaked somewhere around mid-February. I believe it was February 19th. And then we've seen a pullback since. But year to date, if we look at where the stock market started at the beginning of the quarter and where it is today, we're really close to all-time highs in stocks. So while we've seen a lot of volatility, we really haven't pulled back maybe as much or as severely as the media and the rockiness of the market might lead individual investors to believe. So tell us a little bit about what's happening in stocks.
Yeah, and contrary to what the media would publicize or has publicized, the S&P 500 cap-weighted index is only down about 1.5% this year, as of this recording at least.
Yeah.
So number one.
And that's, I think, reflected from the volatility, because at one point, the index reached correction territory, which is 10%. Again, who determines that a number like 10% is a quote-unquote a correction? It's meaningless, but the media can hang their hat on it. So there was a pullback, and the market has bounced back. So it's the volatility that I think people are concerned about, not the overall levels.
Right. And so even within that, though, I don't want investors or individuals that are watching this to come away with an extreme level of fear, because the first quarter of returns in the equity market in the U.S. were negative. So even though that's likely to be true, I mean, all headline indexes are tracking negative in the equity market for the U.S. for the first quarter of this year. But the silver lining to me is that we're about to see something that will only be the third occurrence of such in the last 2+ calendar years. And that's exactly what I'm showing on this screen. I'm showing that over 50% of S&P 500 constituents will likely have outperformed the headline index return for the first quarter of this year. Why is that important? Why is it only the third time that this has happened on a quarterly basis going back to 2023? Because the market has been so dominated and so concentrated over the last 2 calendar years that it's all been driven by just a few firms and really just a few sectors. So it's not all doom and gloom when we look at the first quarter, even if headline indexes print a negative number. That doesn't imply that you had every single company in the S&P 500 print a negative return for the first quarter. Quite the opposite, actually. Yeah. You had over half of companies that outpaced the headline index, which to me, I've talked about this in the past in terms of broadening of returns. I think that does signal a healthy market. And the fact that investors now have more options than just having to pile into a few specific names to generate any semblance of return, I think that's a good thing. And it should serve as a reminder in terms of investors addressing or assessing their level of concentration, because the next 5 years, more likely than not, are not going to look like 2023 and 2024, when it was just a handful of names and a handful of sectors that drove all of the market's performance.
Yeah. I think about, but the analogy that I use is you have the stock market, and then you have a market of stocks. And if you look at the market of stocks, more than half outperformed the aggregate. More than half of those stocks outperformed the market of stocks. The stock market, and when you refer to the headline index number, meaning the number that is reported on the S&P 500 by the media, even though that's negative, the more than half or a majority of the companies outperform that negative number. So that's really, really good data.
Yeah.
Anything else in stocks?
Well, I mean, so that kind of, I would say that's the high level stuff.
Okay.
But and even though we're not tactical in terms of trading and trying to time the market, another really interesting observation is looking at investor sentiment. And we've covered investor sentiment many times in the past in this forum, in other forums with regards to outward-facing media, blue chip. But I do really think, especially right now, it's an important consideration, and it's important to call out, especially keeping in mind that 10% correction that is likely staring people in the face, the negative return that's likely going to be printed for the first quarter. That's made investors at the individual level fairly pessimistic. So looking at things like the American Association for Individual Investors Investor Sentiment Survey, which has data released each week, and basically shows the level of optimism or pessimism that exists across the retail investor base in the U.S., it can have a really, really interesting impact, or I shouldn't say impact, but it can act as a really interesting precursor or a useful indicator for investors in terms of forward returns.
And that's a contrarian indicator, right?
It is, meaning when investors at the retail level are incredibly optimistic, that has historically preceded a period of below average returns. And the exact opposite is true when investors are overwhelmingly bearish. That's generally preceded a period of attractive returns, at least historically speaking.
Yeah.
So what I'm showing on the screen right now, I just want you to focus on where we are at today. So all the way on the right-hand side of this chart, you'll see the blue line down at the bottom, and that blue line is showing you the percentage of respondents to this AAII investor sentiment survey that are bearish relative to those respondents that are bullish. So when you get this line creeping down below 35%, negative 35%, meaning the bears outweigh the bulls by at least 35%, we think this indicator can be really useful at extremes, and we've pegged 35% in either direction as an extreme. And this is very rare that it actually gets to those levels, right?
Yeah.
But when you get below that green line, which is at 35% on the negative fashion, bears outweighing bulls, the forward returns is really interesting. They're really interesting, I should say. What do I actually mean? Well, the long-term average of the S&P 500 index is, roughly 10%, right? Specifically, given the period I looked at, which dates back to about 1990, the long-term average there is about 10.7% for the S&P 500 index. So in this table, I just want you to look at that top portion that pertains to the S&P, which shows you that after the AAII investor sentiment survey indicates that individuals are extremely bearish, meaning bears outweigh bulls by 35%, the forward one-year return for the S&P after those periods on average is 19.5%. versus that long-term average of 10.7%.
So what a testament to being a long-term investor, because as markets drop and sentiment deteriorates, a lot of times that's when we'll get a call from a client and they'll ask, should I get out of the market, or should I be moving to bonds, or should I be more conservative? The fact of the matter is that's almost the time to put your foot on the gas. I mean, not that you necessarily take action, but the reason you want to be a long-term investor and not hop lines at the grocery store is because when things get washed out from a sentiment perspective this badly, that's often when you get the best forward-looking returns.
Right. Yeah, and look, I do recognize that there is still a whole host of uncertainty out there. Corporate earnings through the first quarter that looked at the fourth quarter results were somewhat mixed, but at the end of the day, the message to you guys, to investors and individuals, is that we have good companies that are on sale, and using history as a guide as it pertains to sentiment, I'm interested at these levels.
Fantastic. Really, really good. Okay, let's